Hey, everybody. Welcome to Hub Live. I'm Jeffrey Beamer, Senior Investment Strategist over at EWOTrading.com. Welcome to our show today. We are a week out from the Thanksgiving holiday, and we are seeing a market that is relatively weaker here. So what we're going to do is go through the markets, and then we'll look for some trade opportunities as we do so. And then I will cover the trade that we did from last week on applied material. And then we will get into the trade opportunity for the week. So let's get down to it. We're looking at my chart here of the Spider Index Trust, SPY. You can see that we are trading a little lower today at down 0.6%. But interestingly enough here, look where we're sitting and look where we have sat for now three days. And we could possibly be settling right here for 4 is right at my 21 period moving average. Okay, so this is pretty interesting because let me add another indicator here. You can see this is an oscillator, a 5 period by 535 period oscillator. And I like pulling this up and just, you can see the bars getting a little lower here. And as we head into a holiday week next week, we still have some big names declaring earnings. Things are feeling a little heavy. What I like to do is put on a trade that just kind of covers us over the holiday period, and you'll see that trade here in just a little bit. But I think right now on Spider, this is not necessarily a bad place to trade to the lower prices. Okay, and the reason for this is we could very well hold here and move higher, but it's pretty easy. I would probably look to, at a minimum, setting a stop up here at 600 once again. Anything that crosses 600 on Spider, I would exit a bearish trade. But since we're heading into the holidays and the market is going to be closed as of Friday, after we close on Friday, the market will only be open 4 days out of the next 9 days. Okay, so let's see, is that right? No, 10 open 4 days out of the next 9 days. Yeah, so I think that's right. Anyway, so close Saturday and Sunday, obviously, then open Monday, Tuesday. Wednesday will be very light trading, half day, I believe, if I'm not mistaken. Then we're closed Thursday. We are open Friday, but it will be a very quiet day on Black Friday, and then we are closed Saturday, Sunday. So I love having trades that are what we call theta friendly over that time period. You'll see that in our publication. My Delta Neutral Income publication. I will be putting out some trades if I find some good opportunities that are Delta Neutral friendly, meaning theta friendly specifically, where time value is on our side. We're making money even when the markets are closed. And I got a trade that kind of fits into that category today, as I'll show you in a moment. So here's Spider. We could easily kind of trade down here to 570. And that's kind of the next pivot point. But on the bullish side, for those of you that are bulls right now, we haven't even crossed. Look at this 10 period moving average. We are trading below that, obviously, but the real signal, it would be a cross of the 21 period and the 10 period. So the 10 period dropping below the 21 period. Okay. But look at the separation there. That is very interesting to me, how far apart these are. And you can see the 10 period is now kind of turning over a little bit. So, and then the last thing I'll put on here is my parabolic SAR. We are still bullish on the parabolic SAR. So again, we're fighting between bulls and bears right now. Let's look at Heiken Ashid. What's that telling us? Oh, well, as I zoom in here, my big red candles, look what happened. They got a little wicky here. That's actually good for the bulls. Okay. Now, all it takes is one big red candle here, and we are off to the races to the downside. Okay. That's kind of how precarious it is right now for the S&P 500. but we are really finding a struggle between the bulls and the bears here within the past couple of days. All right, so let me clean this up a little bit. Let's take off that 10 period for a moment. Let's go over to the Dow, represented by the diamonds, the DIA. And you can see here we have nice red candles coming down back into this channel that we have. And look where we bounced yesterday. We bounced right off my 21 period moving average. We're not testing it today. Let me go over to regular candles here. They're a little easier to see what's happening today. So we touched that yesterday, bounced back up, and now today we're down about 25 basis points on the Dow. And we do have some news, just really a lot of stocks are in the red today, but not much on as far as the Dow goes. What is in the red, of course, is in the NASDAQ. All the chip stocks are lower today. They're really struggling. And take a look at this. We're pushing down below my 21 period moving average. My oscillator is getting closer and closer to zero here. Let me just move that around a little bit. Well, I'd like to pull that down if I can. Nope. Make that bigger and pull that down. Okay. So get a little clearer visual of this. And, especially if that goes red, we're going to be pushing down on the Qs. Now, NVIDIA has earnings after the bell today. The feeling is they've really got to outperform on their numbers today to keep the stock elevated. In fact, let's look at that stock here real quick on NVIDIA. So they have an estimated move just at 10%. Now, the thing is, don't know if that's going to be higher. Don't know if that's going to be lower. But the stock has been consolidating here. So a breakout is potential. I know there's a certain chip. I believe it's called the Blackhawk. I could be mistaken on that. Sorry for you tech guys that are fully in the know on this, but I know there's a particular chip that they're really eyeballing. Is this, how is the supply on that? How is demand on that? That's what they're really focused on with NVIDIA as we get close to the announcement here in a couple of hours. All right. So the NASDAQ is hurting today. It's down almost 1%. And but the oscillator isn't as bad, believe it or not, here as on other stocks, but we'll keep an eye on that. And then IWM, the small caps, I knew that we would. Remember, I drew this ellipse several weeks ago. I had ellipse going all the way up here, and I drew this ellipse because I thought we'd run up and then just kind of fall back right into this ellipse. Well, look what we did. We fell back, but we fell back pretty hard, and it looks like we're missing that. So I'm going to go ahead and remove that ellipse there, and you can see that we're came up to that resistance level, bounced right off of it, and look where we're trading, right back down to the 21 period moving average. It's just a song that we sing all the time, and really the pattern is broken here with this. We had this wedge forming, and then we gapped up and went to this resistance area. Now that resistance area is off of a weekly chart. All right, if I see if I can get some data in here, we have to go way back. Okay, right here, and then there's a previous pivot back there, but you can see that that is pretty big resistance, and we hit it and just bumped our head and fell right off of it. So the reason I'm leaving these lines on here is because previous resistance is future support. So now both of these lines would act as support. I would not be surprised if we trickle on down here and then maybe find some support to then turn around and carry us higher. Now, again, that is a bullish view, but the fact that market is overall pretty weak right now, I would not be surprised if we see continued weakness in the small caps. They are really interest rate sensitive. So let's check on the bonds real quick, and let's start with the long end of the curve. All right, so we have the iShares Trust 20-year plus Treasury bond ETF, TLT. the bonds are down about 33 basis points today. That means rates are pushing higher, okay, pushing higher on the long end of the curve. And just look at this performance. We tried to find some stability here around the 92 half level, and then we dropped back down. And now this 90 level is really coming in as some major support. And if we drop back below here, then we could be off to the races in higher rates in the bond market moving forward. And that could be a real issue for other things. Now, we're already seeing that in certain parts of the economy and how that's being affected. Um, I, as I've mentioned before, I have a good friend that's in the commercial construction industry, and boy, let me tell you that has been torn apart here this year as far as big projects and big dollars that are being spent. They are definitely on hold on a lot of projects right now. So I've always called him my leading economic indicator, and from that point of view, they are hurting. I'll throw the 10 period moving average on here. As you can see, it's also respecting that 10 period moving average, but the 21 period, look at that. Every time it tries to get up, and interest rates pushing down, nope, that 21 period just keeps pushing it down. All right, keeps pushing it down. And the fact that both the 21 and the 10 are still, 10 is flattening out here, but boy, they are both pointed south. And it could get ugly. If I bring in some more data here, you can see that we have major support right here, and then also major support at about 87. So if we break 90, good news, we have some support at 87. But then beyond that is, I would hate if we, on the long end of the curve, got below that 87 mark on TLT, because rates would be screaming higher. And you can see they're screaming higher right now from where we were in September. Just dropped like a rock, rates shooting up, and off we go. Now the short end of the curve, again, what we were expecting is happening. They are flattening that inverted yield curve. In fact, I didn't check today, but that, I would imagine, that is pretty much gone right now. Let me just see if I can grab that real quick, because it would be very interesting to see. I've talked about this for a couple of weeks. 10-year. All right, and bring this up here. Oh, so close. So close. Okay, here we go. All right, so we're at 23 basis points. That is actually down a little bit. We got up to 18. All right, we got up to 18, 17. Yep, 17 was the number that we were inverted, and now we've fallen off just a little bit. That's not really a concern. But boy, I'm really surprised that we didn't invert back to where the short terms are paying less than the long terms, which we've had for a while. All right. So that would mean higher rates kind of all around. Let's check on bonds here and bring up the latest on the 30-year, still up above 7% on the average 30-year mortgage. This average right here is the Mortgage News Daily. So this is calculated daily, currently at 7.05. These others are calculated on a little slower curve, like Freddie Mac and the Mortgage Bankers Association, MBA. All right, so they are calculated, I believe, on a weekly basis. So we could see those popping up as we get into next week. But the Mortgage News Daily survey is showing that we are already well above 7 on average right now. So 30-year fixed rate, 7.05, and that's up 0.01% for today. All right. So the short end of the curve is consolidating here down around 82. That's not really surprising. okay, as they try to flatten the curve. So we could see pressure on TLT, meaning rates go up, consolidation here on SHY that would help flatten that yield spread and bring us into the positive, which would be very, very interesting. All right. So this might be some support here. So if we begin to rise on the short term, obviously those rates are coming down. That would also invert that yield curve back to that correct formation where we have lower yields on the near term, higher yields going out further because you're getting paid more to tie up your money for longer. That's kind of the name of the game there. All right. Let's look at oil real quick. Oil's been bouncing around, but it's still kind of neutral. Now, we saw um, with the market, they called it after the election the Trump bump when the markets kind of got a pop after the election. Oil went the other way. Okay. And why? Well, drill, baby, drill. So that will be pressure on oil. And I would expect then prices to remain pretty stable to maybe under a little pressure moving forward. And you can see the choppy market here. So you see all the crosses in the moving average, very choppy market. That's also reflected in the oscillator here where we go green to red, green to red, green to red. All right. And that is a very choppy market. So we're still within this wedge here, though. All right. So I find that pretty darn interesting that based upon the little drawing. So let me go close to close here. All right. I like using closes. All right. And all right. So where do these kind of come together? All right. Not that it would have to stay in here. All right. So interesting. These really come to a head. Look at this. Around, right now where I have it is Friday, January 17th. What happens on Monday, January 20th? Okay. Well, we get a transfer of government, a transition of government. All right. So find that pretty darn interesting how that's setting up there on on um, on this little wedge that we have being built here. So we'll keep an eye on oil for right now, but it's again steady but under pressure. That would be good news at the pumps as we head into the holiday week. They usually will pump up prices a little bit because demand is going to increase, but we'll see. All right, as prices remain steady, if not down on the raw material itself. All right. Now going over to gold and silver. Okay. These also took a little bit of a hit after the election, but now they've found gold here has found some support. All right. And it has rallied for the past few days. It's up 63 basis points today. Okay. Nice little rally for gold. And I honestly am not surprised at this. I am still very bullish on the metals overall. And I think that was just a short reaction and a good buying opportunity. I was suggesting to those that follow me that if you are looking to add to your gold and or silver positions, that this would be a good time with the price being off the highs and back down to prices that we haven't seen since September. Okay, we were here in September, then we rallied up. Okay, now we pull back to those prices, and now we're off to the races again. So let's see what Heiken and She tells us, and we're going to have some nice green candles there. Look at that. All right, so a V bottom here, and then 3 strong soldiers here. That's actually pretty bullish. I would expect to see this oscillator continuing to these red bars continuing to shorten and go over to the green here relatively soon. And we have parabolic SAR. We got today is the first bar, okay, of let's go over to the regular candles. So today is the first bar. And you can see the little black dot where my crosshair is, okay? So if you were short, okay, so you were short up here at 253 according to parabolic SAR. and then now you're getting out at 244. So again, this is why parabolic SAR isn't necessarily a good trading system. You would really have to modify the settings and really get dialed in to maybe fit yours. But I like looking at it kind of on a macro basis. It's just a piece of information that I add to other pieces of information. That's all. Okay. Just one piece of information that I add to all the others. But gold has had a nice little rally here, and we would, I kind of expect it to continue. Now, silver is under a little pressure today, down 1%, but it did, it had a little bit of a rally here. And there are those that, boy, I sure need to clean this chart up. All right, so let's do that here a little bit. I have folks that have been talking to me about metals. They are metal experts, and boy, some of these guys are really bullish on specifically silver. Find that interesting. And some of the things that they're saying I can't repeat because I don't think it would happen in my lifetime, but they are very bullish long term on the metals, both gold and silver, but especially silver. We're forming a higher low here is all we're doing. It actually kind of matches this low here, but when you compare it to, back here in September or back here in August, okay, this is still kind of an overall bullish pattern. If I started, the pullbacks a little. I was thinking about an Elliott wave count here: 1, 2, and then 3, and then a 4 pullback. But that 4 pullback is a little bit deep. That would probably disqualify it from an Elliott wave count. Well, I'll just throw it on there to see. I'm still counting it as a 4, but that oscillator I think might be. I'd have to measure that oscillator out to see if it's a valid. But look at where we are: 61.47. Okay, on that 4 right there. So almost a perfect 61.8, right? And then here's where our tap box is. The middle of that tap box is the end of January. Okay, and honestly, I actually kind of like that setup here. We probably legitly got our trigger yesterday on the 19th. I like that. I like that trade. So this is not your trade of the day, but this is a trade for the day. Okay, I would look at going long silver with and what you want to do here, since we're option traders. How we do this is I would essentially come out to the end of the tap box, and you can see that's Wednesday, February 19th. I would probably use February options. Okay, even though my target for me is in the middle of that tap box, so at $33 or 32.5, depending on where your pricing of your strategy is. And I would look at an out of the money calendar spread, maybe selling January, buying February, something like that, or selling January, buying March. Okay, calendar spread, see if that is a good price, or a butterfly up there, maybe a 30 by 32.5 by 35 butterfly. I would definitely take a look at something like that. And again, using January options somehow in that mix, and for a butterfly. And I think that would be, you might be able to get that for, dirt cheap right now, and just leave that out there. And you'll be amazed at the potential returns that you can get when you go far out in time like that, and you put your trade, out and up or out and down, and you get these tremendous potential rates of return. And it's just like anything else. It's more like a lottery ticket. And if you are right on your prognosis, man, you get paid big bucks for a little bit of patience. And that's all it would take. So I would do a trade like that and then just set it and forget it. I mean, I don't have to worry about it. I don't have to really look at it except for once a week, maybe, and just let it go. Again, it's all about pricing. Okay. I'm looking for a minimum of 3-to-1 risk, a reward to risk ratio. 4 to 1, 5 to 1. You'll okay, and you'll not believe what I'm about to show. I'm about to show you that something that has over a 6 to 1 reward to risk ratio in just a minute. Okay, 6 to 1. Okay, so for every dollar we can make six. All right, so um, that's the power of going out in time. All right, so there's silver. All right, let's take one look at the VIX real quick, and we see that we held support here, and let me take Elliott Wave off, and rallied off of support, and we're getting, we're getting a little bit of a rally here up at 17.5 today, and we got this big red candle. Thought we were going to head down to 14. Well, look at that. We closed right at 14. How about that? Did we really close at 14? We closed at 14.02 on that day. How about that? And then we closed a little higher the next day, and then boom, Monday or Friday the 15th, we get this big green candle, and now we're off to the races. If I put a hike in a she on there, they're all going to be green. Okay. So no wicks on the bottom. Well, you had a wick yesterday on yesterday's candle, but these are all um, just big, green candles, and fear coming back into the market is all that is. But we're back up to 17, and Rob and I on Thursdays we've been kind of talking about this, how the VIX has been staying elevated for a while, maintaining this higher double digit number, and that's a concern. So for the markets. All right, so let's just touch on a couple of cryptos here real quick. Bitcoin, man, this thing is off to the races, and off its highs today. Okay, it was trading over 94,000 earlier today. Well on its way. When you get to this level, you are heading up towards $100,000. Okay, I will not be surprised if we, in fact, we could hit it next week. All right, the way this thing is going, might take a little longer, but definitely by the end of the year, we could see Bitcoin at $100,000. And I was listening to somebody yesterday, and they said they had 14 Bitcoins. Okay, well, just do the math. That's well over $1 million. Just he's had them for years and years and years and years, and probably bought them when it was very cheap, and now well over $1 million. So at these current prices, but boy, so there's Hike and a She on here. I can just pretty much remove all drawings. Let's go back to a nice clean chart here. Big bullish surge in the oscillator, moving average all pointed higher. My 161 moving average is finally pointing higher on this. Let me go back to regular candles here, and you can get an idea. Boy, that is just a super move. Now, it is pretty steep technically, and we don't like things that are steep and vertical, but there's some extenuating circumstances here, as Bitcoin is up 1.25% today, but Ethereum is not. Ethereum is down 2%. I find this pretty interesting. It has not participated like Bitcoin has. All eyes are on Bitcoin right now, and look at this candle. Oh boy, we could definitely see a pullback. And where would we go? Well, 2750. I mean, I would not be surprised if we don't go back to 2750 on this, as we get big separation there between these two moving averages, and the 10-year is finally turning over. And I would not be surprised. So in the next week or two, we could see 2750 on Ethereum, as it's showing some real weakness. All right, so that's our tour around the market. Let me take a look at two sectors here real quick that have caught my eye, and I meant to put a couple of others on here, but we were talking about energy a couple weeks ago, if maybe not last week, and look at this. We're off to the races. Now, the line I drew here, okay, it was measuring out this inverted head and shoulders pattern. Okay. So there it is, the inverted head and shoulders pattern. It's at the bottom of a pullback, okay, which is a valid um, place for a head and shoulders pattern. It needs to be at the top of a trend or a bottom of a trend. It needs to take 3 to 9 months for a proper butterfly inverted head, or for any head and shoulders to form. And then if you recall, last week I kind of measured this out, and I had a target of 102 on here, and we're well on our way. Okay, so we did that last week, and you can see we're just a little bit higher. So again, this is something that we would see going out in time, and I would do something at $100. So here we are today at 95. Why don't you look at a 95 by 100 by 105 butterfly, price that out. And again, if I can get a minimum of 3-to-1 risk to reward on there, doing that all day, every day. Okay. Especially on a sector like this. And interesting that the whole sector of energy is up today, 56 basis points, considering the market's down. That's quite the resilience. And then home builders, they're under pressure. I find this, I was attracted to this just because it was showing some strength today, but it is well off its highs here. And as many of the home builders are reporting some possible pressures, and the numbers are suffering a little bit. Look at the respect for the 21 period. Once again, it came right up, now fell off, and look where it's trading again, right here at the 21 period moving average. So let me get a sense of trend on here. Pull up my Heiken Ashi, and okay, we had a series of red bars. Now we have a green one. So we would just kind of monitor that, see if we hold here, and if we got another red candle, then I'd probably do something to the downside. All right. If you're not already bearish on builders, this is kind of a good place. Another red bar here off of Heiken Ashi, and I would definitely be bearish to the downside, especially if these moving averages hold. Because look at that, you got the 10 and 21 period right there together, where the stock needs to come up. Okay, so with that said, let's move on to our trade. Let me first of all talk about last week's trade. That was Applied Materials. Now I'm going to show you the risk graph of it, but I'm going to take it from our platform because the timing of this trade, timing was everything on this trade. We made a small profit in the trade, okay, and if you were delayed or you weren't awake, and the stock at the end of the day was on the decline, you could have had a small loss. Okay, so I'm going to show you what that looked like here. All right, so the trade alert went out. Okay, so this was our trade that we did here, same trade that I did in the publication, our Delta Neutral Income portfolio, and that's why I'm showing you this. Okay, so here the exit on this. Okay, so let me show you. If you don't recall, I'll show you the entry. Okay, so here was the entry on this trade. Okay, and we talked about this during the day. It was just 2 days long. We were looking for an earnings play. All right, and credit of 52 cents. All right, we did it twice. So $104 was our maximum reward on the trade, and all we're looking to do is get through earnings. Okay, so Friday came. We sent out the alert, and look what I said here. I said they announced earnings. As long as Applied Materials stays above the short strike, which is 170, we should be fine. However, with the way that stocks are reacting these days, I'm inclined to exit this position while it is above our short strike of 170. That was the key, 170. So let me show you the image here. All right. We sent out that alert and we exited the trade with only 19 cents of profit. Okay. That's at then times two, okay, is 38 cents, right? 38 cents. So this was the time. Now, at the end of the day, the stock closed near the lows. Okay. So if you were, were using those rules you definitely profited. Anything at 170 or above was a profit from about $16 up to where we were at 38, if not even more. If you took it right away, you probably made a little bit more in this trade than we, not much, but you could have made a little bit. If you fell asleep at the wheel and you just kind of, at the end of the day saw it, you could have had a loss up to about $100. Okay. So not a huge loss considering our max risk was almost $400. You could have lost about $100 of it. All right. But for our purposes, when the alert went out, we had a small profit of 19 cents per trade, and that was the result there. All right. So I have another trade for you today. All right, and this one is along the themes of what I was talking about a little while ago. Okay, and let me go back to the charts. We're going to do a trade on the S&P 500. Okay, we're going to do a trade on Spider. This is going to be pretty easy as long as we stay, our where we need to start watching this trade would be if it breaks above that 10 period moving average, and specifically 600. Okay, if we get above 600, I definitely want to exit. So here's the trade for you. Okay, it's on the S&P, the Spider Index Trust (SPY). This is a butterfly, all right, and it goes out to December 31st, all right. So we are using options, quarterly options that expire on December 31st, all right, closing out the year. But I want you to look at this number up here, this max profit versus max risk. 687% is the maximum potential risk. Now, the general rule with a butterfly is don't count on that. Okay. I have a moderate amount of butterflies. I've had a moderate amount at best that nail that strike right at expiration. And it's pretty fun when it happens because I like playing what's called the gamma theta war. Okay. Those two Greeks don't like each other and they play havoc on each other. But as you can see right now, gamma is very small and theta is actually very small. All right. But look at this. Theta is positive at the moment, even though we are still not below our upper break even. If we drop below this upper break even as we get into the trade, look at the profit zone here. So if we get down to 570, which is where I think we might be going, we could actually drop to about, between that 560 and 570 area. As long as we're living in there, we'll try to get this up where, we're making 2 to 3 times our money. Okay. That's the goal. 2 to 3 times our money. If it's 6 times, great, but that's very unlikely. So how I would do this is you can do this one of two ways. You can just do one trade, or if you have a portfolio of stocks, your broker should have a way for you to see what's called the beta weighting of your stocks, of your portfolio. Okay, and how much your portfolio is correlated to a particular index, and you can usually choose a particular index or stock that you want your portfolio to be indexed to. Okay, but S&P is pretty typical, and so if your beta weighting is say 75, well then your portfolio will react essentially for every dollar move in the index, you're moving up 75 cents or down 75 cents for every $1 move. Okay. If that's what your overall beta is, that's also a way to calculate how much you should hedge your portfolio. Okay. And so what I could do here is say, okay, my potential profit is $1,700 for if the market drops 5%. So what you would do is calculate what a percentage drop down to 570 to 560 is, okay? And then how much you need to hedge, okay? How big this position needs to be. And your insurance, okay, is going to cost you $2.54, okay, per spread. $2.54 per spread. And so the point here is because of the risk reward here, you don't need to do a lot of these to hedge a good part of your portfolio, okay? And for us, I might just do one of these, okay, and keep it dirt cheap because I have, look at this, I have a potential profit. what if I make $1,000 on this? Okay. Well, that's a significant return on portfolio. Okay. For our hypothetical, for our delta neutral income portfolio, which is where this would fall. Okay. The hypothetical portfolio value is $10,000. That's a 10% return. That's a 10% return. Just for a little bitty hedge on portfolio when the market dropped 5% or 7%, whatever that number is. Maybe it's 3%. I'd have to calculate it out. But again, so this is our trade here, December 31st. So let's go through this. We're buying the 585 strike put. Okay. We're selling 2 of the 565 puts and then buying a 545 put. That 545 put is called your trash leg. Its only purpose is to hedge off the position. Your real position is the 585 and the 565 diagonal. Okay. That 545, what some people will do is they will actually do, say, a 585, 565, and then do maybe a 525 or a 520. That's called kicking that leg out. And again, reducing that debit here. Okay. Reducing that debit here. And that does change the risk graph, and you would need to model that out. But again, I'm not expecting to make money on this one. The only 2 that I'm expecting to make money on are my 585 getting more expensive, and then time value eroding away on these 565s. That's how I'm going to make money in this trade. This 545, don't expect to make money from it. Don't want to make money from it. The only reason it's there is to hedge off the extra. See, the 2 is to hedge off that extra 1 put at 565. All right. I hope that makes sense to you, because that is kind of the purpose. But again, it's just priced in at $254 right now. And again, these are December 31st options, buying the 585 put, selling 2 of the 565s, buying 1 of the 545s, 3 legs, okay, for $2.54. That is our trade. And we will monitor this weekly until we take the trade off. Okay. I'll do that for you, is we'll keep an eye on this as we go through the rest of the year. So with that said, that is our show today. All right. So last week we had a nice trade that generated about 35 basis points to portfolio. We'd like to get more, but that's what it did for us. This week, we're looking for a much bigger play, but it's going to take some time. All right. So everybody have a nice week. I will not be here next week, the week of Thanksgiving. All right. I will be with my family, and hopefully you will be with yours as we celebrate the Thanksgiving holiday here in the U.S. All right. So everyone have a great week, and I will see you again here in 2 weeks. So everybody take care and happy holidays.